Stock markets take a leg lower because we're apparently going to get a run of auto tariffs coming from the White House, but we don't have the announcement yet. And ultimately, the markets don't run too far away. So while we wait for fresh fodder, we'll take an opportunity to look at a bigger, maybe even a more impactful story here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive, and we are going to turn our focus to Europe because this has been a major part of what we've seen come out of the new Trump administration in the U.S. and the realignment of global relationships that it has engineered or is engineering. Of course, one of the biggest stories here has been the idea that Europe has become skeptical about the reliability of the U.S. military umbrella and wants to build out a massive rearmament effort so that it can take care of its own defenses without relying on the American backstop for the first time, really, since World War II. That has moved markets because, of course, such a thing would imply a tremendous amount of spending. And the real question is, well, we've heard this song and dance from Europe before. In fact, in the first Trump administration, there was an attempt to get NATO, that is to say mainly Europe, to build more guns for themselves and to shoulder more of the load for NATO and a more representative share to their actual membership. And so is this, in fact, different? Because the last time that this was attempted, Europe ultimately said all the right things and didn't do very much. Is this time different, and is the market reaction then going to actually be sticky? Can we trade on it? That's what we are going to focus on here today. So first, let's take a look at what the markets have done so far, and then we'll take a deep dive into why the markets will or won't believe, then come down to a trade idea on that basis. So, first and foremost, we can see the U.S. dollar has been down since the beginning of the year, and the euro has led the way. Now, of course, we can see the dollar has pulled off a little bit of a recovery here in the wake of last week's Fed policy announcement, where the Fed basically said we don't need to rush to cut interest rates. But we can see from the beginning of the year, this is the start of 2025 right here, the euro has clearly been an outperformer, starting basically from late February going into March. So the yen here was outperforming, and then the euro from about late February into March rapidly surged ahead, at one point up as much as 7% year to date against the dollar. And of course, now we've seen this pullback, the euro still right on the leaderboard there with the yen, but a little bit of dollar strength here pulling the entire complex down. Nevertheless, we clearly see that something happened right here to dramatically catalyze the euro, and to a lesser degree the pound, but certainly the euro, to this dramatic outperformance. Of course, the first step in figuring out what all is going on here is to see what is the driver of the euro US dollar exchange rate. And we can see that here in clear representation. The purple line here, the spread between German and US 2-year bond yields, that is to say the front end of the yield curve in the US and in benchmark Germany, which is a stand-in for the Eurozone writ large, typically. It's the largest economy. And so we see here this very close relationship between where the euro goes relative to the dollar and this spread, which of course makes all the sense in the world. This is classic stuff for currency markets. The currency you want to own is the one that confers a higher yield And we can see here that as the yield differential between Germany and the U.S. moves, so too does the exchange rate as the yield advantage or disadvantage of the given currency moves around relative to the other. So here, for example, we can see from January of 2021, we start to have, from about mid-year, a conversation at the Fed saying, okay, it's time to hike rates. The hikes, of course, don't start until well into the first quarter. In fact, toward the end of the first quarter of 2022. But of course, markets are forward-looking. They speculate. So once the Fed around June of 21 starts talking about, okay, maybe this inflation isn't, quote unquote, a transitory thing, and maybe what we need is to really go on a hiking cycle, you see yields shift against Germany. So as this yield narrows, that's U.S. yields going higher and German yields losing step, relatively speaking. You can, of course, see that this is reflective of the U.S. having a yield advantage compared to Germany. And so here you go from about a negative 1% disadvantage for Germany down ultimately as you get into 2022 of a disadvantage in excess of 2.5%. And the euro follows. Subsequently, you see things correct. Most recently, of course, from September of last year to the beginning of this year, the markets were thinking maybe the Fed is sounding too dovish and they're not going to do all the hikes or all the cuts, rather, that they are saying. So you get a shift, again, in the dollar's favor in the yield spread, and the dollar strengthens. And then, of course, since the beginning of this year, you go the other way again. And this is the most recent surge in the euro. And you can see that, right according to form, it matches with an upshift in relative yields, where Germany looks a bit better on the relative yield spectrum compared with the U.S. than it did before. And that's how you get the move in the spread and in the currency as well. So what's going on here? Well, as with the exchange rate, so to the yield spread, there's a pair in this dance. On the U.S. side of things, we can see from September through to the beginning of this year, inflation expectations implied in the bond market, that's these break-even rates up here, the 5 and 10 year, they're rising. The yield curve is steepening. The 2-year, the 10-year rates, they're going up. Bonds, of course, in parallel are falling. And the dollar here, the dollar index, it's up. That is this move right here. And what we see since then is inflation expectations start to roll the other way. The dollar starts to roll the other way. Yields start to roll the other way. We start to see the change in this yield spread. We start to see the euro perk up. So from the U.S. side of things, you have lower U.S. interest rates, of course, shifting the yield gap in the euro's favor in relative terms. And we know at this point how this is happening. The leading PMI data, essentially a measure of business confidence over the past 3 months, has screamed that the economy is threatened by uncertainty around tariffs and fiscal policy in general, and companies are pulling back on spending, and that's hit economic activity growth, including in the service sector, which of course isn't immediately hit by the tariffs, but is impacted by them tangentially and in sentiment terms. And that's exactly what we've been seeing. So the market has taken to expecting that this will mean a more dovish Fed. And last week, the Fed didn't take the leap, but certainly commiserated with markets and said if only we were to see this kind of weakness go from survey data like business and consumer confidence to hard data like jobs and inflation, well, then we'd have to act. As if to say, yes, markets, you're right that we've become a bit more dovish in our thinking, even if we haven't in our actions, and sort of endorsed this move. At the same time, on the German side of things, yields have surged. This is, of course, looking a whole lot like what you see both in the yield spread and in the euro. And you can see it happens in the transition from February to March. So if you were wondering how the euro was lagging here and then surged to outperformance, this is the move you're looking at, and this is the bond move behind it. So not only is the U.S. side of the yield spread moving such that you get more euro advantage, but you likewise see the same thing from the European side. That is to say, their yields are moving in a way that even further shifts the yield spread in the euro's favor relative to the dollar. Okay, so apparently the markets have heard the idea that in Europe you now have increasingly the president of the European sort of regional legislature, Ursula von der Leyen, saying that what we need is a big build-out of defense spending. You're seeing Germany, forever the tightest purse strings in Europe, basically since they had the hyperinflation leading into World War II in the Weimar years. Germany has been incredibly suspicious of debt and of expansionary policy. You nevertheless have a situation where they've said that with the need for a military buildup, you now have a exemption for defense spending from the constitutional debt break that would cap that kind of spending in Germany. And of course, if you were to now have a huge amount of money pouring into defense contractors, that suggests a huge boost to economic growth. The numbers that we're talking about are astronomical from the lips of incoming German Chancellor Friedrich Merz and other leaders. Of course, France's Emmanuel Macron, the president there, he's argued for a more assertive European posture for a long time. He's talking about a European nuclear deterrence independent of the U.S., powered mainly by France and the UK, both nuclear powers. So there's clearly a level of spending that the markets are anticipating will come, and they think it's a lot, and they think it'll be a tailwind to growth, which of course then is a tailwind to inflation. It means fewer rate cuts from the ECB, so it means higher yields and higher euro. So far, so good, but do we trust it? Should the markets trust it? Or is this again a familiar song and dance? Well, certainly looking at German inflation expectations, they seem to have taken notice, and in the near term. So if we look at longer term inflation expectations, they jump on this news, but then they sort of settle to where they were before. And this is 20-year, 5-year, in this case, the 10-year with remaining 8 on it for the current bond. But near-term inflation expectations, they're still surging. They're still at some of the highest levels that we'd seen in 6 months. After this rebound, there was a pullback here, but now we're right back up here. And this seems to suggest that the inflation that the markets are anticipating is coming near term, that the spending is going to be front loaded, that the impact is not in some distant future. Moreover, ECB policy expectations have taken notice. Not only have we seen the stock of rate cuts for this year diminish a bit, but now for the first time in really going back to the beginning of last year, the markets are actually anticipating about a 50-50 shot that the ECB will have to raise rates next year. 14 out of 25 basis points of a rate hike are now on the menu here. And that amounts to about a 56% chance that the ECB hikes rates. That obviously speaks to a significant inflationary impetus from stronger growth around this build-out. So again, the question becomes, well, the markets believe it now, but will they still believe it later? Or is this, again, another one of these rhetorical things that ultimately fades? And this is where a bit of theory helps. The great economist Robert Mundell came up with something called the optimum currency area theory that seeks to explain why a country would want to join a currency union. And this really tells you and illustrates very nicely how it is that the EU and indeed the Eurozone came to be, and explains all of the economic troubles, hiccups, and various crises along the way, and how what they've been in practice isn't so much an existential threat, though it feels like it at the time, but rather a forcing function for the project to advance. So consider this. If you're a country, some would-be country, that wants to join a currency block with some group of countries or one other country, but you want to consider whether you should have a joint currency and enter into a currency union, as the Eurozone is. You have a structure of costs and a structure of benefits. Over here, you have the degree of prior integration. So how close is your economy already with the block or the block of economies or the economy that you're seeking to join? And over here is just costs and benefits in some theoretical units. And the logic goes like this. If you join a currency union, you lose independence of monetary policy. In other words, you have a single currency, you have a single central bank. If you need interest rates to be lower because you're in economically dire straits, but the bloc needs them higher because they're doing well, well, then that's not advantageous for you. But if there's already a lot of economic integration, then chances are that you go through booms and busts at about the same time. And so you don't care about giving up some monetary policy independence for the benefits. And the benefits are, of course, the more trade you do, the more integrated you are, the more you extract from reducing friction, like borders, tariffs, quotas, all manner of rules getting a common denominator between you and the currency block. All of that makes doing business cheaper, easier, smoother. And of course, that is a tremendous economic benefit. So the more that the would-be joiner of a currency union is already integrated with the union it wants to form or join, the more it cares about the benefits. So as integration goes from 0 and up, the more the benefits matter and the less the costs matter. And there's a magical, obviously theoretical, equilibrium point here, beyond which the benefits outweigh the costs, and it makes sense to join the bloc. Let's follow this logic to look at the European Union, and if you look at it on purely economic grounds, even Robert Mundell himself would argue that the Eurozone is not an optimum currency area. That is to say, it is not economically sound. The level of integration is insufficient. Even things like the Maastricht Treaty, the Stability and Growth Pact, that mandates greater degree of symmetry and integration by saying members have to have certain budget thresholds. They can't run higher. They have to have certain common economic criteria, convergence criteria, they're called, so that there is symmetry in these business cycles. We, of course, find out in practice those things were not there, but integration happened all the same. So economically, it didn't make sense, and we have a litany of crises along the way to demonstrate that this integration ex ante was not sufficient. Certainly, the Eurozone debt crisis of the 2010s, 11s, and so forth, that makes the point loud and clear. But nevertheless, we have this thing created. How? Well, consider what mutual defense does to this calculus. And consider that the first European communities were European coal and steel, military industry, European atomic energy, military industry. That's in addition to the trading bloc or customs union. And so you immediately see that the goal starts being France, basically, saying we want to be integrated in German military industries such that German tanks don't roll into Paris again. And when you consider it in the context of this model, you would say, well, is it an economic benefit if there isn't war? If you reduce the chance of war? Of course, the answer is yes. If infrastructure isn't being destroyed, consumers aren't being conscripted, then the economy isn't being disrupted. So the avoidance of war is an economic good thing. How do you reflect that in this chart? Well, the area where benefits outweigh the costs should get bigger if the thing you're doing is good for the economy. What does that mean? Well, it would mean the benefits line shifts by a force other than the costs and benefits themselves and the degree of integration. Some outside force shifts the entire line such that this area grows by this right here. What does that tell us? It tells us that the acceptable level of integration goes down. And now the participants will accept less economic perfection in the structure because the military benefits outweigh. And this is the story of the southern expansion, where Greece, Portugal, and Spain are admitted, even though they don't have the economics for it. This is, of course, the initial conception of the entire thing, and France wanting veto power over German military might. On and on and on it goes. And every time that this thing hits a crisis, much as now, this logic is the forcing function for deeper integration and for the killing of sacred cows and for the breaking of things that were thought unbreakable and for the creation of something which maybe doesn't make initial sense. So the upshot seems to be that Europe should be believed. This fiscal tailwind really is coming because this is exactly the kind of forcing function that usually moves Europe to finally get to doing stuff. And so this pullback that we've seen in the euro here after this surge, resting now right around the 108 area, looks much more like a buying opportunity than it does the fizzling out of a move that isn't credible. And although we don't necessarily have confirmation to get long at the moment, the upshot seems to be that wherever this settles, here or perhaps a bit lower as we continue to probe down, the path of least resistance, perhaps structurally now for the euro, is higher. And this weakness is a chance to participate with a bit of a bargain price relative to what we saw even last week. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm also writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Happy trading. Macro Money's back tomorrow.